Are you ready for some major updates about your Canada pension this November 2025? This month brings some of the biggest changes we've seen in years. From benefit hikes that could put extra money in your pocket to new tax rate alerts that might impact what you actually take home. Whether you're retired, soon to retire, or simply planning your financial future, these updates are too important to miss. Let's break down exactly what's changing, who's affected, and how you can make the most of your pension this November. Welcome to my channel, where we bring you the latest and most reliable updates on pensions, benefits, and financial changes that matter to Canadians. If you want to stay informed about your retirement income and the latest government updates, you're in the right place. Every month, millions of Canadians rely on their CPP and OAS benefits to help cover essential living costs. But with inflation still putting pressure on household budgets, any adjustment matters. That's why November 2025 is such a crucial month for pensioners. The federal government has just confirmed new increases to the Canada Pension Plan benefits, along with revised contribution and tax details for both workers and retirees. But while there's good news for those receiving benefits, there are also some alerts you need to be aware of, especially when it comes to your taxable income next year. Let's start with the good news. The benefit hike. The Canada Pension Plan, or CPP, has been steadily increasing over the last few years under the government's long-term enhancement plan. For November 2025, the average CPP retirement benefit is now set to rise again, bringing the maximum monthly benefit close to CAD 1,433, depending on your contributions and eligibility history. This adjustment reflects both inflation indexing and the ongoing expansion of the CPP program, ensuring your benefits better keep up with the cost of living. This increase means that retirees who qualify for the maximum amount could see a noticeable difference in their monthly deposit. For many seniors on fixed incomes, even a modest hike can make budgeting a bit easier, especially with rising costs for essentials like groceries, healthcare, and utilities. But remember, not everyone receives the maximum. Your personal amount depends on how much and for how long you contributed during your working years. For those who recently started receiving their CPP benefits, this November increase will be automatically reflected in your payment. There's no need to reapply or submit any new documents. The adjustment happens automatically through Service Canada, so your November 26, 2025 payment should reflect the updated rate. However, while higher benefits are a welcome relief, there's another side of the story you need to know: the tax rate alerts. As benefits rise, so does your taxable income. The government has also confirmed that some income tax thresholds and contribution rates are being adjusted for 2026, and these changes could affect how much tax you'll owe on your pension income next year. For working Canadians still contributing to CPP, the maximum pensionable earnings limit is expected to increase again, pushing the contribution ceiling higher. This means that while your future benefits will grow, you might notice slightly higher deductions from your paycheck in 2026. It's a small change, but it can add up, especially if you're near retirement and trying to balance savings with day-to-day expenses. For retirees, this means your total taxable income could move into a higher bracket if you combine CPP, OAS, private pensions, and other investment income. So, it's a good time to review your tax strategy. You might consider consulting a financial advisor or reviewing your retirement income plan to ensure you're not paying more tax than necessary. Many experts suggest spreading withdrawals or leveraging tax credits available to seniors to minimize your taxable amount. Now, let's talk about how inflation plays into all of this. The Consumer Price Index, which measures the cost of goods and services, continues to be a key factor in pension adjustments. Over the last 12 months, Canada has seen moderate inflation enough to trigger the indexing process, but not as steep as the pandemic-era increases. The new pension rate for November 2025 reflects this, ensuring that retirees don't lose purchasing power as prices fluctuate. At the same time, the government's fiscal policy aims to balance these benefits with sustainability, ensuring the CPP fund remains stable for future generations. The Canada Pension Plan Investment Board, which manages the fund, recently reported strong returns, maintaining confidence that the CPP remains financially secure, even as payouts increase. For seniors currently receiving both CPP and Old Age Security, or OAS, it's important to note that OAS benefits also saw a recent adjustment in line with inflation. Combined, These two programs now provide better support to offset cost pressures, especially for low and middle-income retirees. The maximum OAS benefit for those aged 75 and older has also seen a slight bump, giving older seniors some extra breathing room. Another important alert this month relates to tax brackets and benefit clauses. If your combined income crosses certain thresholds, you may see a partial reduction in OAS payments through the OAS recovery tax. The new threshold for 2025 is expected to be around CAD 90,997, meaning if your income is above that level, you'll begin to repay a portion of your OAS benefit. It's another reason to carefully track your total income, especially with CPP benefits increasing this year. Thanks so much for watching. If you found this update helpful, please give this video a thumbs up and subscribe to the channel for more news you can use. See you in the next video. November is here, and with it comes some important updates to your CPP and OAS payments. Let's break down what's new for November 2025 and how it affects your wallet. First, the big news. Your CPP payment this month will include the latest inflation and enhancement adjustments. For those eligible, the maximum payout is now hovering around 1,433 Canadian dollars per month. It's a welcome boost, but it's not just free. Monet comes with some financial homework. Let's take a practical example. Imagine you're a retired couple, both receiving CPP and OAS. With these benefit increases, and maybe some investment income, your total household income could easily creep up. While a bigger monthly payment feels great, it might push you into a higher tax bracket, leading to a surprise tax bill at the end of the year. So, what can you do? A smart move is to use registered savings plans, like an RRSP, or even the new FA, if you're eligible, to help balance your taxable income with deductions. It's all about being strategic. Also, don't forget to keep an eye on your provincial tax updates. Some provinces adjust their tax credits or low-income senior benefits based on federal changes, so your income thresholds might shift. Beyond taxes, let's talk about security. Service Canada is constantly improving its online tools, making it easier for you to manage your pension information through your My Service Canada account. But with these improvements comes a warning. Scams targeting seniors are on the rise. Remember, the government will never send you a text or email asking for personal details to process a pension increase. Official updates will only come through your secure online account or direct mail. Stay vigilant and protect your information. If you're getting close to retirement, November is the perfect time to log into the government portal and check your personalized CPP retirement estimate. This shows you exactly how much you can expect based on your contributions so far. This information is gold because it helps you decide the best time to start taking your CPP, whether that's at 60, 65, or even delaying until 70. Waiting longer means a bigger monthly check, but the right choice really depends on your personal situation, your health, lifestyle, and other financial needs. Financial planners always stress how crucial this timing is. Starting early might give you needed cash flow, but delaying can significantly boost your long-term income. Looking at the bigger picture, these adjustments are part of the government's plan to keep the pension system sustainable as Canada's population ages. The good news is that actuarial reports confirm the CPP fund is solid and fully funded for at least the next 75 years. That's a huge relief for both current and future retirees. Plus, the ongoing CPP enhancement program means younger workers are contributing a bit more now, for much better payouts down the road. It's a long-term strategy to ensure everyone has a reliable, inflation-protected income in retirement. For those still working, you might have noticed the second earnings ceiling under the CPP enhancement. This allows higher income earners to contribute more and, in turn, earn additional retirement benefits. Yes, it means slightly higher deductions now, but it's building a stronger financial safety net for your future. So, here is the key takeaway as we head towards the end of the year. Don't just celebrate the extra cash in your bank account. Take proactive steps, review your tax strategy, monitor your income thresholds, and be on guard against scams. With changes to contribution and tax rates coming for 2026, a little planning now can save you a lot of headaches later. To recap, your November 2025 CPP payment is updated. The maximum is around $1,433. Review your income strategy now to prepare for next year. Staying informed is your best defense. Check your Service Canada account regularly. If you're unsure about any of this, have a chat with a certified financial advisor. Thanks for watching and staying on top of these important pension changes. If you found this helpful, please give this video a like, subscribe to our channel, and hit that notification bell so you never miss an update. Stay informed, stay secure, and I'll see you in the next video.